Good morning, everyone. My name is Francis Sabourin from Sabourin Wealth. Welcome to our Q3 2025 review on this nice Monday, October the 6th, 2025. With me, Hassan Ghaffari-Aram. What about the market? Markets Defy Dow for this last quarter. How can you explain this?
Good morning, everyone. Happy the fall is starting. Yes, definitely the market has defied doubt itself. It was an amazing positive with so many all-time high for the market across the globe. As you see in our first slide, the best performing was China. China delivered 20% return for the third quarter, thanks to the new injection of the money through the institutional and government, semi-government pension funds, and also a little of better sentiment through the retail. They're not coming back yet, but they put a little money into the market. However, when we look at the China, the fundamental is still under question. We have still a low growth, and the PMI is not back again to the high position. However, in the other side of the water, in Japan, we are seeing a very, very strong momentum, especially when we were sleeping last night. The election from the new prime minister, the first lady as the prime minister of Japan, took power, and she's dovish. She's dovish in the fiscal policy, and she's also putting pressure on the BOG not to increase the rate. It's very fascinating to see that. Before last night, the expectation in the market was that we're going to see 60% chance of increase from Bank of Japan due to high growth. However, after the election, that probability plunged to 30%. And the Japanese stock market was up 4%, and the yen was under the pressure. So you all have the Japanese exposure. We were bullish on the Japan for quite some time. Now it's another legs up for us, and we're quite happy about that.
Yeah, and we'll talk later about the Canadian market, which is not part of that particular graph.
For sure.
So what about high frequency data that speaks by itself?
We are in a time that high frequency data is also important. We are in a time that the government is shut down, so we don't have that much of information that we wanted to have in regular. So one of the metrics that we really love is WE, Weekly Economic Index. So it's a combination of job market, employment data, production and output, like how is really on the floor of economy happening, and also consumer spending. It's about retail sale, the same store sale of the stores. Combination of these factors brought you to that orange line, as you see. When the orange line is stable, usually the market goes up because it means that things are in order. When the orange line starts to going down for quite a period, then you see the S&P 500 or the market reacts really, and you see it perfectly here. Right now, the only constituent of this WEI, which is in a little of concern, is employment data. We're going to go through it in the US. So let's go to the next slide and see what's happening in the job market. So we are talking about the economy. Economy is about GDP, the gross domestic production, how much really an economy produce, and then the employment, the people who works in an economy and then consume the earnings. So as you see, that's for the United States. As you see, in 2025, the latest GDP read that we have, as you see here, it's a huge upside in net trade after the Trump April announcement of the tariff. So it was a huge increase in actually less import and trying to have more export. And also you have a huge investment, the green part. Huge, meaningful investment, which is the CapEx. These CapEx is mostly from the tech companies, all these data centers and AI infrastructures. Also, the consumption is healthy, it's more than 0%. So as you see, the US economy, is at the standard it's supposed to be, it's meant to be. Consumers are consuming, and also the company are putting money in, most tech-oriented company. Now let's go to the kind of staying in the same slide, but let's go to the
Canadian one.
Canadian one. If you go back a little, I just want to explain something.
Sorry.
Yes, about the wage growth. The economy from GDP is strong. We are going at 3.8% GDP growth. However, the employment, the US earning is not going up. So this is the puzzle station. So if the economy goes up, but I don't make that much of money, what is missing here? So this is the question that now economists try to answer. by going down, by not increasing the wage. Look at the graph at the right. You will see the average hourly earnings and the average weekly earnings are in the downward. It's not bad, but it's not going up. That's the question.
If we go to the Canadian economy, it's a bit a different story.
Canadian economy is a different story. It's like the other side of the coin. Look, let's start with the big fat down net trade. As you see, it's all about there's no export. That's a problem. And then also stock building. Stock building is like an investment. Investment, there's no investment. There's no green block in 2025 because the capex, we don't do capex right now at the moment in the corporation, Canadian corporation. And the stock building is that inventory doesn't go away. Inventory stay in Canada, or inventory stay at the inventory of the people because there's an uncertainty at the maximum. That's a problem of Canadian. And you see the orange line is going down. That's our GDP trend, which was 100% opposite for the US economy. However, in the earnings side of the Canadian market, you see in the graph next to the right, the growing rate of the Canadian employment is pretty much same as the US part. It's more volatile, but same pretty much as the US. So our economy is not growing fast, but we are at the time of no firing, no hiring, stay, let's see what's happening. That's the status of Canadian market at the moment. Next slide, please.
And what about the consumer impulses? I mean, obviously, there's consumer are quite strong.
So at the end of the day, it's all about: do you consume? Do you spend? So the consumer expenditure going to go to the economy. That's a real factor, which is very important. So the first graph that always we check is the top right. The orange is disposable income, and the blue is consumption. There's a positive gap, means people save. That's good. However, finance is all about changes, delta. When we go to the delta, there's a little problem, or not a problem, a little concern. If you check to the year-over-year change of the consumption versus saving, you see the blue line is now on top of orange line. It means that the people are spending at a faster pace than they save. The question is, how sustainable is that trend? This is for US market. So to answer that is that, okay, back again to the question. The US economy is growing at a good pace of 3.8%, but employment is not high enough. What's happening here? There's three explanations to this puzzle. The first is maybe there's improving productivity. All that you heard about the AI, let's check it. As you see in the chart down, the blue and the green one, the blue is the US productivity. It's actually how much value each hours of work produce in the US economy, job market. It's higher than Canadian, it's a little go up. This is a very small change, but when you compound it in 10 years, 20 years, that's a huge difference. So yes, productivity is going up. However, it's not a full explanation because it takes time. We're still at the very first moments of capex for AI. It takes time to really materialize our labor productivity. The other explanation maybe is going to be, you know what? Soon we're going to see the demand going to go up and catch up with the GDP. That's a good scenario. That's the worst case scenario that maybe is going to happen is that consumer stop spending. So there's three explanations. Economists doesn't know which one is true or which one going to happen, but the best is going to be the first and the second, and the worst is going to be the third scenario.
Good. And what about the yield curves?
Yes. So why it's mattered for us first, because you have the financials in your portfolio, and we were bullish about the financial, and the financial delivered perfectly in the year to date and in the past quarter. So first, what is this graph, these lines? It is the yield on different maturity of the government bonds. For example, when at 2 years you have 4.2%, you had 4.2% in December 2024, and at the moment you have around 3.5% yield. So the yield curve tells you that how much it costs to raise now and how much it costs to raise in future. And when the shape of these yields change, the financial, like the banks, react to that. You want a steep, like The longer you wait, the more yield you want, and the sooner you collect, the less yield you demand. So when it's a normal yield. When it's like that, when it's steep, the financial market usually play well. And that's why you see that all the holdings that you have in your financial part of your portfolio deliver an amazing time. Goldman Sachs was about 12%. Goldman Sachs is not only the yield curve play, also the M&A. We are at the time that the M&A is huge. Every day you have a deal closing, IPO, someone is buying another one. Like I have data here, for the Goldman Sachs, $1 trillion of deals in the IPO for the third quarter happened in the United States in just 3 months. It's huge. And the number of the deal more than 10 billion was 47, which is the record high. So this is Goldman Sachs business. And that's why the Goldman is 12%. The best one for the QT, the expectation for the QT among your financial is the Bank of America. We're expecting about 13% EPS growth here because Bank of America is more toward the consumers of the United States, mostly on the mortgage. And we're going to see when the yield curves goes down, parallel shift down, you're going to see more activity in that part.
Good. And where do we stand now? Obviously, people are asking, is it a boom? Is it a bubble? Well, where do we sit actually?
Such a $1 trillion question, even more, huh?
Not an easy one. Not an easy one.
Not an easy one. So there's no way to time the market, but we can learn from the history for sure. So let's see first where we stand. This noisy, very crowded chart show you where we stand geographically. So of course, the United States has the highest price to the earning ratio, the PE, and then the lowest one goes to the emerging market, which makes sense because if you look at the graph, the scatter graph on your right, you will see the volatility of US market is much, much lower than the other part of the world. And that's explained why you have the very structured good premium on PE in the United States. However, still again, the question is it cheap? What history tells us? If we so
trailing PE
exactly
and forward PE.
We have trailing PE, which is the historical past 12 months price to the earning. We have the future PE, which is based on the expectation of the future earnings, and I put also the 2000 peak. So Meta was like Microsoft right now is trading at 38 PE, and it was 51.
In 2000.
So, in 2000, yeah. Dell was 75. Cisco was 100. The only one which we don't have Tesla, and we are not against the Tesla, but we don't have it in our portfolio. Like it's trading at 252. Yeah, maybe that one is a little rich in valuation, but the rest of the market is not really at a very red flag situation now.
Good. And what about gold?
Oh,
this is the story.
This is the story. So, first as Canadian, we all love gold, and it's delivered perfectly. So, what happens to the gold? When I look at live data, it's up the bullion is up 48% rate, and it's a huge jump for the gold. So why the gold is in demand? Why people love the gold? First, it's a policy easing. Wherever you see across the board, fiscal policy is easing, monetary policy is easing. Even Japan, the only developed country which was about to increase the rate, now we are expecting either pause or wait for the longer term. So that's an easy policy. Weaker dollar, the dollar goes weaker, it's better for the gold. Asset rotation and diversification. It was this morning that Financial Times reported that it's now across most of the survey, 2% of the fund managers now have gold. So, or increasing the position to the gold. Also, pension funds are buying some golds now. Central banks are also buying golds because the fiscal policy of developed market is in question at the moment. And they're scared that maybe the value of the money is not that it's supposed to be. So they resort the value to the gold. Also political, all the political problem that we have. So when I wrote this, it was Fed independency. Now maybe we should put it Fed and other central banks independency. A prime minister in Japan last night got elected, and the probability of rate increase in Japan has plunged 50%, although there's supposed to be a separate schools. So yeah, that's pretty much the story of the gold. If you look at the graph at the right, you will see how inversely correlated the price of the gold in the yellow or orange bar to the valuation of the dollar, the exchange. I put the euro and the basket. It's mostly important about the euro to USD, but when the dollar plunged, the gold will go up. And that's the story at the moment.
Yeah. And in Canada, I mean, as you mentioned, we talked earlier about the performance around the world, but we didn't talk much about the TSX or our own Canadian equity benchmark. But as we know, gold bullion or gold miners and the Canadian TSX is a huge weighting, which we don't own much. We own ABX, Barrick Gold, which is a weighting that we love, but it has been doubled, twice the price we paid actually. But nonetheless, we should have been way more overweight gold, but it's not our style. We don't like cyclicals, even if we have one with Barrick Gold, but it's not, or it's more an exception in our portfolio, but an exception has been doing quite well so far.
If I want to echo your point, Francis, let's look at from the practical big picture. So the bullion, the real gold in the third quarter was up 16%. The gold miner were up 45%. That's the operational leverage. That's why we added Barrick Gold. We knew that the gold will go up when the dollar was at the high last year. We said, okay, that's not sustainable. With this fiscal policy, we're going to see the plunge in the value of the dollar. So we add to the operational leverage of gold, which is the miner. And then, so that's the difference of the gold bullion and the barracks, why we choose the barracks. The other part is about Canadian material sector, the TSX. It's hard now to beat the TSX because it's very tilted toward the miners and also junior miners. So Canadian material sector is up 37%. Look at the chart top right. You see that little blue dot. That's a Canadian performance for the material sector. Look at the US part. There's a huge gap. That's because we are tilted toward gold. Not only gold, like Barrick, the big miners, Canadian small cap. Look at the Canadian small cap. It's 22% up versus the Russell, which is the US small cap, which is 10% up. What's the difference? Juniors. The junior miners in Canada perform amazingly. You can see it in the small cap relative to the large cap in Canadian market. You see a huge legs up. That's junior miners that's happening. So as Francis said, why it's not our style, but we definitely seized opportunities, which we did with you double your money with the Barrick, but it's not our style in the long term. Look at the conceptual difference, a structural difference of the Canadian market versus the rest of the world in the left bottom chart. The orange is a Canadian market, that's a dividend yield. Canada, then you have the developed market, then you have the S&P 500. When a company distributes high, it means that they don't reinvest. When they don't reinvest, it means that they already capture all the opportunities. There's no growth left that much. Our portfolio, your investment is about sustainable growth for future. And that's why the gold was not our play for the long term, but we definitely captured the opportunities.
Yeah, and as we know, the TSX is up 24% year to date, and half of it, about 12%, is related to gold mining stocks, either small, large, or medium. So this is not our style. So that's why we've been kind of a bit underperforming on the Canadian side. But we know that this has been the best quarter for gold stocks for, I think, not forever, but for at least 25 years. So we will be patient. We have seen that movie before, and we're not scared to death. So as I mentioned, we are building portfolios for the long run, not for the short term. So this is a conclusion of our presentation. So partner with us. If you feel that you want a copy of this presentation, either ask me, Hussein, Jean-Marc, Christopher, Michael, or Stefan, or will be available to get this either in French or in English, and you will get your performance report coming out soon. So you will see that there's been a very decent year-to-date performance. So even if we didn't have much gold in our portfolio, but we had some. So thank you, and talk to you next quarter.
Thank you so much.